A covered call is an option strategy in which an investor will buy stocks on a certain company and then sell calls on the same stock. And this has the effect of allowing the investor to generate additional income from selling those calls, but at the risk of decreasing their potential upside if the price should rise substantially higher. Now let's hop into Excel and model out why someone might write a covered call and what conditions would make them either win or lose that position. Let's start off by defining our variables. So the first variable here is the stock price at initiation, which we'll denote as S0. And we're going to say it's $30. So if we wanted to go out and buy one share of this stock right now in the market, it would cost us $30. Our stock price at expiration will be called ST. And we're actually going to be looking at a whole different array of potential stock prices at expiration. The call option premium, we'll denote as CO, is going to be $4. So that means that if we sell this call option today, we will receive $4 from whoever bought the call option from us. And then finally, the strike price, we'll call K, is going to be the amount that whoever we sell the option to, they have the option to buy the underlying stock for $28 when this call option expires, regardless of how much the actual stock price is at the expiration of the contract. Let's discuss what might be our payoff as an investor if we only buy the stock and we don't do anything with the call. So if we just go long on one stock, meaning we buy one single share, we can see how will we profit or loss based on all of these potential different stock prices at expiration. And so we've got our formula here, which says that our profit on one long stock position is just going to be equal to the stock price at expiration, ST, minus the stock price at initiation, which we paid $30. So we can just find that out by saying equals ST minus, and then our stock price at initiation. I'm going to hit F4 to lock that in, enter, and then I'm going to shoot it all the way down. So for this particular example, we paid $30 for this stock. Now it's only worth $20. So at the time that we close out of this position, we have lost $10. And you can see that when we get back to $30 here is when we actually break even. And we can see the same thing over on this chart. At $30 is exactly when our profit is even with zero. And then for every $1 increase or $2 increase, see, we're up $2 now if it goes to 32 versus if it goes down to 28, now we're down $2. Okay, well, what happens if as an investor, instead of just going long the stock, we also go short one call option? This would be equivalent to a covered call, which can possibly generate us more income in the event that the stock price doesn't rise too high. So let's map out the profit we might achieve if we short one call. So that's the formula right here. So profit for shorting one call is going to be equal to, because we're the ones selling the call, we get that $4 right there. But now we can potentially lose money based on what happens with the price of the underlying stock at expiration. So the payoff for a call option to whoever owns it is going to be either the maximum of the amount at expiration of ST minus the strike price. And let's think about why that is. So if I own a call option, I can buy something that's worth this price for only this price. So right now, I would not buy something that's worth $20 for $28. Instead, I just wouldn't execute that. So it's either a maximum of that value, which is a negative value, or zero, because I have the option to not exercise it. So in that case, whoever sold the call option is just going to be up $4 because the counterparty will not exercise it, and they'll just keep their $4 and they'll be happy that they entered into that contract. Now let's shoot it down. So it's going to stay at $4 up until we get past the strike price. So let's scroll down and look at that. So once we get to 29 is when that short call starts to deviate from being a $4 payoff. And why is that? Because now the person that we sold the call option to, can buy something from us that's worth $29 for only $28. So we lose $1 on that, but we keep the $4 we gained. And so now we're only up $3. By the time we get all the way to 32 is when it breaks even. And then once we get past 32 is when the person who was on the other end of the contract is the one that ends up being better off than we are. And we can also see that mapped out here in this chart here. So if you short a call, you are profitable when this gray line is above 0 here. So you're profitable all the way up until you hit 32, and then you start being unprofitable. But what happens if we combine a 1 long stock position with a 1 short call position? That is a covered call. So we just combine these two payoffs. So we combine the payoff of the long stock and the payoff of the short call, and we'll shoot this all the way down. And now you can see that the covered call strategy, we're going to compare it to the long stock strategy. So if all I did was go long 1 share of stock, I would have this orange payoff line. But if I do the covered call, which means I both have that one long stock and I sell 1 call option, now I have this blue payoff line. And what this blue payoff line is telling me that in all the events where the price is below $32, I'm better off having sold that call short. I end up with more money. And I'm particularly profitable around where this anything above 28. Anything above 28, I'm basically up $2 in all of those circumstances. So this is a good income generating strategy because you can end up with more money this way. However, the downside is that with that long stock, if that price keeps going up, I keep benefiting and benefiting and benefiting and benefiting and profiting more. So by selling that short call option, I've lost all of my upside for a smaller amount of income generation. So if you guys would like this Excel file that I created, you can click the link in the comment or the link in the description to download it for free. I hope you enjoyed this video, and please subscribe for more content just like this in the future. Thank you.